Alrighty, good morning, everyone. Thank you for joining us today. So today's topic at hand, topic we'll be discussing is building a bankable business, how to become capital ready in New York City. My name is Jose Alaman. I'm a deputy director at the at Small Business Advising at the Lower Manhattan Business Solutions Center. As some of you may not know, the Business Solution Centers are part of the larger Department of Small Business Services, otherwise known as SBS. At the Business Solution Centers, we offer a wide range of free services like business courses, which covers topics such as marketing, financing, business operations, and much more. So if you're interested, you can check out a link in the chat with my colleague Stephanie will be posting. You can check out all of our upcoming courses within that link. At the Business Solutions Center, you can also get set up with a pro bono legal and accounting consultations where you can speak with a lawyer or a CPA on topics like forming your business structure, trademarking, commercial lease agreements, bookkeeping, and credit counseling. With our business finance support, you'll get connected with our financial advisors who help businesses across all stages to access the funding they need to launch, maintain, or grow their businesses. Our team can also help you determine if you qualify for any incentive programs and possible cost-saving initiatives with our many trusted lending partners in the city. We also have our Cannabis New York City program with a specialty team dedicated to help guide, and support you throughout all steps of your small business journey as a business in the cannabis industry. If you're interested in a consultation with our team, please follow the link that is within the chat. Again, Stephanie will be posting a link there where you can set up a consultation with our team if you're interested in any of our services. Additionally, I'd like to acknowledge our other partner in today's webinar, which is the New York City Fund Finder platform. Stephanie, can you go to the next slide? Yeah. Sorry. Yeah. Additionally, I'd like to acknowledge our other partner in today's webinar, which is New York City Funds Finder. New York City's Funds Finder is a fast, free, and easy marketplace where small businesses can review funding options, including loans, grants, and request one-on-one finance assistance from the SBS team. To date, over 13,000 small businesses have registered on the platform and access free essential services. If you are already a registered user to the site, we encourage you to make a free appointment with an advisor today. You can schedule on your dashboard if you're interested in doing so. And if you haven't registered on the platform, we encourage you to do so today. And finally, and especially for this conversation, I'd like to tout the New York City Future Fund Loan Program. This is a special revenue-based program offering loans between 25,000 and 500,000 with a low interest rate of 7.5%. That's below the market rate. It's designed to be stress-free. If your business has a slower month, your payment gets smaller too. It's built to work with you. So you can focus on your work without worrying about making a rigid bank payment every single month. Again, it's a flexible loan program, which kind of molds to how your business fluctuation. Before I introduce our speakers, I'd like to highlight what you can expect to learn today. What we'll be discussing is what it means to be capital ready, how lenders evaluate your business. We'll be discussing common reasons businesses are denied from funding and how to fix them. We'll also discuss building strong financials in a bank-owned business, how to identify the right lending partner and product, and preparing a strong loan application with the support of an advisor. With that, let's meet our panelists as I'll quickly introduce each of them and I'll quickly introduce each of them and let's share that when we have this panel together, we wanted to make sure we had a broad set of perspectives presented. You'll hear directly from a lender providing funding through the platform and from an advisor offering guidance and support. So let's meet Connor McCarthy. Connor McCarthy is a director of lending at Grow America. He's a seasoned professional in the financial sector. He specializes in access to capital for small businesses, with a robust career that includes roles as an analyst, originator, and closer. He's mastered the art of effectively providing capital. His journey has taken him from a community development financial institution in the vibrant South Bronx to lending with leading SBA, 7A, and 504 lenders across New York State. As a director of lending and portfolio management at Grow America Lending, Connor harnesses his expertise to empower small businesses, ensuring they have the financial support they need to thrive and succeed. Next, let's like to introduce Stephanie Washington. Stephanie Washington is a senior account manager at the Manhattan Industrial Business Service Provider, or IBSP. Stephanie Washington has over 10 years of experience helping entrepreneurs obtain financing for both pre-startup and operating businesses. Throughout her career, she has been able to assist businesses in the New York City area connect capital solutions that allow them to start or enhance their businesses. Through her work, Stephanie noticed there was a gap within her community and became determined to close in through education. Through Next Street, she hopes to demystify finance and lead others to financial freedom. I want to thank you both for joining us today. So now let's get started, shall we? To start, we want to understand the problem. We want to understand the problem and what is capital readiness? And let's start with Connor. Connor, what are the top three things you look for when evaluating a small business for funding?
That's a good question. I think to start, obviously, bookkeeping is going to be critical. So I would make sure that you're making that investment in quality bookkeeping and that you're filing tax returns and filing them on time. That's really kind of the financial information that a lender uses to understand the story of your business and really to understand where it's been and where it's going to go with the capital that you would source from the lender. So I would say first and foremost, bookkeeping, quality of record keeping is critical. And then as I was kind of getting into it as well too, I would also say when you approach that lender, have a clear, and it doesn't have to be too complicated, just clear articulation of what you're looking to do with the money, what it will be used for, and how it's going to lead to the growth of your business. So bookkeeping, I think, is critical, a clear vision of what you're going to do with the money. And then the third thing I would say too is it's okay to go into that lender conversation knowing what you know, that is like being an expert at your business, and then being kind of vulnerable and realizing that you don't have to be an expert in business finance. So if you pair with a good lender, they're going to be able to demystify a lot of that process for you, the terms, the process, et cetera, et cetera. So those would be the three core things I would say you should approach the conversation with.
Amazing. Thank you, Connor. Stephanie, next question's for you. What are the first steps a business should take before applying for funding?
Yeah, that's a great question. So I think one of the first steps I would encourage you as a small business owner would be to check your personal credit. Ideally, we'd like to see above a 650, 700 would be better. So first check your personal credit before looking for financing. I think also to Connor's point, have a list of the doc of what you're going to use the funds for. So is it going to be purchasing equipment? Are we looking to hire new staff? Make sure you list it and also list the cost of it. Maybe if there's more than one that you're going to need, itemize that as well. And if you can also have the link to what you're looking to purchase, that shows that you're serious about what you're looking to do. Oftentimes business owners will come to us and say, I'll take as much money as I can get, but it's a little bit of a red flag when you're just asking for whatever you can get. But when you have it itemized, it's definitely helpful. And then the last thing I would say here is having your financials ready before we're having that conversation. So typically we need the last 3 years of tax returns. If you are a pre-startup, obviously you don't have your business ones, but we would need your personal ones. For pre-startups, we'll need your business plan and financial projections. For operating businesses, we'll look for your profit and loss statement year to date and your balance sheet as well. So those are typically the documents, or yes, documents needed to start the conversation with the lenders. There are additional documents, but these are the typical ones you see for all the lenders.
Thank you, Stephanie. And the next questions, I'll 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 lean towards the two of you. The next question is, what are some common misconceptions small business owners have about getting funded, or getting funding? I'll start with Connor.
You have to understand that a lot of lenders themselves, and there's different types of debt. Like if you're looking for debt in the pre-revenue space, or if you're looking for debt before you have the ability to repay, that's a different type of debt. For most of the debt that you're going to be sourcing through the program that we discussed today, but also just in general term debt, you do have to show some level of cash flow, which translates loosely into profitability. And so keep that in mind when you approach this conversation. You should be approaching this conversation with an understanding that you have the ability to take on and repay on an annualized basis some level of debt. If you can't do that yet, that's okay, but it just generally means that you're not ready for that lender conversation and that you need to do a little bit more work on your end before you approach the lender. So that would be a core component of any conversation that you're going to have with a lender.
Stephanie, what are your thoughts on that?
I think when it comes to like misconceptions, and that's the question, right? I blinked a little. Um,
Yes, what are some common misconceptions small business owners have about getting funding?
Yeah, thank you. I think it's the turnaround time. So people will apply for funding, and especially if you're looking for a larger dollar amount, they expect to get it in 2 weeks, and that's just not realistic. So when you're coming into the space looking for funding, keep in mind it could take longer the larger the dollar amount that you're looking for. So I think you should have to be more strategic when we're looking for capital. If you need it immediately, you might not be able to get the capital that you're looking for.
Awesome. Thank you, Stephanie. And that kind of actually touches on the next question, which is what does the lending process look like? Time to close, uh, et cetera, et cetera. Uh, Connor?
Yeah, I think that's a great question in the sense that we've known for a long time that borrowers are willing to trade rate and term for speed and efficiency, and it's a horrible trade-off. If you're going to source well-structured, well-priced, long-term debt that actually gives your business the capital it needs to grow, it takes a little bit longer. For most term debt, that process will take 30 to 45 days. And any lender that's coming to you, basically, again, trading rate and term for speed and efficiency, you're going to pay for that. So keep that in mind. Like that could actually hobble or hurt the business in the long term if you decide to take that option or make that choice.
Stephanie, did you want to add anything else to that, or?
I think it also helps if you're prepared as the client. So the quicker you can get the documents to the lender, the faster they can move. And so typically we see the bottleneck is not necessarily the lender, but it's the client because they didn't have the financial documents ready beforehand to have that conversation.
Amazing. Thank you, Mo. Thank you for those responses and that insight. I'm going to drive us forward in this conversation. Next, I want to discuss how to better understand the system, um, and how lenders evaluate, specifically how lenders evaluate prospective borrowers and why businesses get denied. Let's start with Connor again. Connor, what are the most common reasons businesses are denied for funding?
I think it always helps to orient across what we're looking for. We call it like our credit box or our buy box, and there's four key components. We're looking for folks that have good character. If something happened in your past, just disclose it, and we just want to know why it's going to happen and why it happened rather, and why it's not going to happen again. The second thing we're looking for are capacity building projects. So projects that both are a testament to management's current capacity, but also to the fact that our loan funds will lead to the growth of the business. The third and perhaps most important thing, and I've talked about this or alluded to this already, is this concept of global cash flow, so repayment ability. So most lenders are going to be looking for some level of historical repayment ability based on the tax returns that are provided by the business. The fourth and final component is collateral. A lot of lenders are going to keep collateral as a consideration, but it's not the core consideration. So if you have good character, capacity, and you have repayment ability, but you had a collateral gap or a lack of collateral, most lenders that work in the space that we all work in, kind of in this economic development lending space, are most likely going to approve a loan, even if there is a lack of collateral. So that's kind of the core organizing foundations or pillars that I would use when thinking about how deals are getting approved or whether they're not getting approved.
Connor, and just follow question to that. Are those core pillars also how you as a lender assess risk when considering a business?
Yeah, they just go one kind of one and the same. So risk and those core pillars are really the same. It's really kind of our appetite around risk is what I'm describing. So it's a good question, and that's how we assess risk. It's a real synthesis, if you will, of the borrower's character, of the capacity of the business and where it will grow with the loan funds, of their repayment ability, and then collateral as a mitigant in the absence of either a strong repayment ability or really in the absence of of collateral, or rather a kind of a collateral gap. So you take all those together, and they seem simple, but it's really kind of we joke it's like kind of an art form rather than a science. So we're taking all of those items, bringing them together, and then making a decision from there.
Got it. Thank you. And Stephanie, what are some common financial mistakes you see small businesses make on your end?
Yeah, I think I want to list two. The first one I want to start with is hiring a tax preparer as opposed to an accountant or a CPA. So when it comes to like accounting and financing, we have two different goals. Your accountant is trying to make sure that you have less to pay back in taxes, but in doing so, it makes it harder for us to see cash flow on that tax return. So when you have an accountant or a CPA, you can have better conversations as opposed to what your long-term goals are. So if you want to like open a brick and mortar space in 2 years, having that conversation with an accountant or CPA, they can start formulating your tax return to show profitability, to show that the business has the capacity to pay back that debt, and you can get the funding that you're looking for in the future. And the second point is co-mingling your funds. The business and your personal funds should be separate. They should not be intertwined. You should not be charging personal expenses through your business account. Your business should not be like this cash box that you tap into whenever you need something. You should think of the two as two separate people, and you don't intertwine the two. So make sure you keep your personal funds and your business separate.
Love that. And the next question I'll aim to two of you. Uh, what role does business credit play when accessing capital? Let's start with Stephanie.
Yeah, I get this question a lot, and I blame social media. For the purposes of getting funding at the stage that we are right now as a business, we do not need to worry about business credit. We just need to focus on our personal credit. And I saw some questions in the chat. There are free resources through the City of New York, through the Office of Financial Empowerment, where you can work with an advisor for free. You've already paid for this with your taxes, and they can help you get your credit to a better place. So right now, you don't need to worry about business credit. And it also depends on your industry. Certain industries, it's not a concern. I see it more with my construction businesses where business credit is more important. But right now, just please focus on your personal credit.
And Connor, from a lender's perspective, how would you respond to that
I think
question?
business credit is really just kind of like an indicator. You'll see some like issues or blemishes. It's not really, to Stephanie's point, the decider. So I always kind of am a little bit mystified that people end up like referencing this so much. So like, oh, I'm going to take out this loan so that I can build my business credit. And I'm like, you could do that, but I don't think that's going to be a central deciding factor in whether a lender approves you or not. The core things I was talking about before prior, those are really what are going to decision our loan. Sometimes on business credit reports, we'll see some interesting things, like maybe like a blemish or some sort of, lingering court or legal issue that came up that maybe even the borrower wasn't aware of. But these are all kind of resolvable things that we can at least just follow up with a quick phone call, figure out what happened and, what's going to be leading to the resolution of these issues. But as far as kind of like comparing apples to apples, saying that like business credit is the same as personal credit, I wouldn't say it is the same.
Thank you. Yeah, we hear quite a bit of small businesses coming to us, bringing that up as a topic. So yeah, thank you both for your responses. So finally, let's discuss how from the perspective of borrowers, excuse me, let's discuss how borrowers can take action to become bankable and have a successful application. Let's start with Connor. Connor, how important are financial statements and what specifically are you looking for?
Critical. We've been talking about this throughout. I think also just it's simpler than you think, probably. Like manage your margin. It's a simple profit and loss statement. If you're showing the ability to net profit and to really kind of show what we call cash flow after you add back non-cash expenditures for depreciation, amortization, and interest, then we're probably going to support your request. So that's really how critical and how central that P&L or really the profitability on a tax return is. So I would kind of start there, and I think everything flows off of that. The other thing I keep talking about throughout this presentation is, again, if you're working with a good lender, they should be explaining this to you. They should be explaining this in an approachable, understandable thing. Like any lender that's kind of using ratios and terms and all these different things, like they're not as important as you would think. Like a lot of what we're talking about is pretty straightforward to understand. And anything that's a little bit more complicated, they should be able to kind of explain that to you. So if they can't, that's kind of a red flag. If they can, and you understand what's going on, why, and why that's either going to move forward or not move forward at that point in time, then I think you're in a good position.
Before
Thank you,
Jose,
Con.
you ask your next question, I do
Yep.
want to echo that the point Connor just made. Ask questions. You are an expert in your field, in your industry, but when it comes to financing or necessarily running a business, you may not understand it. So ask questions. Don't think like, oh, I sound too stupid or I should know these things. Why would you know these things? We don't learn this in school. So please do not be like hesitant to ask the lender questions. You want to make sure before you sign legal documents that you completely understand what you're getting into.
Thank you both. Thank you, Connor and Stephanie. Next question I'll ask you, Stephanie. How can advisors support businesses throughout their funding journey?
Yeah, so that's the fun work that I get to do. So specifically within the business solution centers, again, a free service that Jose mentioned that you've already paid for with your taxes. The process typically looks like we'll have our initial conversation and I will ask a series of questions to see if you are financing ready right now. If not, I'll let you know, okay, we have to work on your personal credit. Here are the resources that you can do to fix that, or we need to get your documents in order. These are things that you should focus on. You should talk to this accountant. I don't have accountants that I can recommend, so please don't ask me. And then helping you get to the point where you're bankable or ready to get a loan, then my job is to find the appropriate lenders. So if it makes sense for me to connect you to Grow America Fund with Connor, I'll have a conversation with Connor and see if he's interested in the deal. If Connor is, then I'll make the connection between the client and the lender. At that point, it's not that I disappear. If you have follow-up conversations with the lender, maybe they say something that you were too shy to ask questions on the call, we can have further conversations as to what he was referencing or whatever the lender was referencing, and then the closing process. And then you can come back to me in 2 years when you need additional capital to grow your business. So that's how I can help hold your hand throughout the process.
Love that. And I'll aim this next question to Stephanie, but Connor, feel free to jump in if you'd like as well, okay? Stephanie, how should a business owner prepare for a lender conversation or application?
Come talk to me. But you should have a clear understanding of what your business does. Basically, the high points in your business plan. What is the business? What do we do? What differentiates the business? Who's our target market? How do we plan to get money coming in the business? If we're looking to expand the business, what are the expectations of and the expected return on investment for this? I like the things I mentioned earlier, check your personal credit, getting the documents together, and having a clear understanding, is the capital that I'm going to bring into the business, is it actually going to help, or is this already a sinking ship? Because oftentimes business owners think if I just put more money into it, it'll work. But maybe your expenses are just too high or your margins are too thin and it's not a business that can be salvageable with capital, but instead like a reorganization of how the business operates. That could be a tougher conversation to have with an advisor, and it may not necessarily be myself, but being honest with yourself. Is this business a healthy one, or is this a business that's dying? I think is helpful.
Connor, any thoughts on that?
No, I'd echo a lot of what Steph is saying. I think what's kind of fun about the capital acquisition process is like you're not only just acquiring capital, you're actually learning something about the business and about yourself. So, to Steph's point, like kind of a weird part of this that we don't talk about is like, let's say that you approach a conversation with Stephanie or a lender for that matter, and you realize like my business is just not doing well or it's not profitable. And like, here's a path to profitability, or here's a path that tells me like this couldn't work out, or there's something I need to change here. it's kind of a really cool byproduct of the lending process. Like if you're doing lending right with the right lender, you should be learning something about your business, and then the result is capital. I think oftentimes people approach this conversation as like capital, 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 and I understand why. I think capital is critical to growth. I think capital is what people are looking to acquire. But on the other hand, though, too, like if it's a good lender and a good process, you're going to learn something about your business, where it's going and where it's going to head with that capital. And you might also learn something that you have to change. And that's a net positive as well, too.
Well, yeah, thank you both. Um, and then Stephanie, finally, what are some essential resources like New York City Funds Finder you share with small business owners to help them in their funding journey?
Yeah, so you all have the luxury of living in New York City where we have a bunch of free resources that you can take advantage of. So if you don't come to us at the Business Solution Center and if you don't go to Funds Finder, you can go to SBDC, Small Business Development Center, and it's a federally funded program, so it's also free. And they can help you with templates for financial projections for those of you that are pre-startups or those of you that are looking to expand your business to the next level. They can sit down with you to look over your business plan for the pre-startups in the room. There's also Start Small, Think Big that helps as well with the finances of your business. And I would always recommend the library. So we have business libraries here in New York that you can meet with a librarian if you want to maybe further understand your target market or understand the industry norms within the industry that you're in. And within the library, they have SCORE mentors, which also are federally funded and free. And they can also maybe help guide you. I will say, with the SCORE mentors, I've heard mixed reviews. Some mentors are amazing and some are awful. So when you're going into that, just keep that in mind. You may be paired with someone who's not that great, but you paid for it with your taxes, so try to find another mentor.
And Connor, what are your thoughts?
I think New York is an exceptionally cool spot to be opening a business in the sense that like there are some barriers to entry. Like I think it's more regulated, there's more permitting. Obviously, it's highly competitive, but I also think there's a plethora of resources. And so as a business owner, if you're not availing yourself of those resources, many of them are free, but some of them too, I also will caution like they're as valuable as you make them. So you have to like kind of advocate for yourself and push forward those resources and do some of the work. But it could be the solution centers, it could be the libraries, it could be the SBDCs. It could be a series of kind of quasi-public, not-for-profit partners in the neighborhoods that you work in. There's a plethora of resources out there that are phenomenal. And so, to the degree you can kind of lever all of them and work with them, you're going to be that much better. And I think one of the fun things about business ownership, or even for me, I've worked on the capital side of this dynamic with business owners through, I mean, I think I've done this for almost close to 15 years. It's a process in which kind of learning never stops. So, if you're availing yourself of these resources, learning from these resources, even if you're a little confused at times, that's still like you've taken the step. So I would really kind of utilize these. I lend nationally. Not every city or state has these. And the quality can vary, but here in New York, and New York City especially, the quality is exceptional.
Thank you both. Um, and then what's one thing every business owner should stop doing and start doing when it comes to funding? Let's start with Stephanie.
Oh, that's hard. We mentioned stop commingling, so don't do that. I would say start getting comfortable with the profit and loss statement, also known as the income statement, also known as the P&L. So you guys know all the names for it. But I would encourage you to, if you're not familiar, we have classes that can give you like a high level understanding of it through the city. You can also go on YouTube. There are great videos that can talk in more depth as to the importance of it. But this is a tool that you can use to just plan strategically for your business. So you can look at it month over month, compare it year over year, see trends within your business. Maybe you don't need additional funding. Maybe you notice that you're spending too much money on Ubers, and maybe we just have to start taking the train as opposed to Ubers. So I think become more familiar with the financial documents within your business, and that could be a true sign for we do actually need capital to grow. Let's look for financing, or there are other things that I can do to help this business get more cash flow so we can operate comfortably.
Connor, what are your thoughts?
My thoughts to start are kind of like approach the conversation with a lender and with any of these capital providers that are assisting in that process with a degree of kindness and with humility and just with listening. I think we live in a world right now for various reasons where people, want to talk first and listen later. And so, um, oftentimes on both sides of this dynamic, people are trying to tell each other things. And you'd be surprised at the amount of times I get on phones with applicants and they're trying to kind of like talk over a dynamic or a part of this risk management system that I'm trying to explain to them. And they think that, by continuing to talk at that's going to lead to the outcome that they need. And unfortunately, it's not, right? Like we're mitigating risk. We have different parameters and profiles that we're looking for specific to our credit profile. And certainly, too, another part of this too is like if you're getting a no from one lender, one, take that information and figure out how you can get to a yes. And then the second thing I would say too is like you should shop it out. You should see what other lenders have, what their risk mitigants are, because everybody has a slightly different profile and what they're looking for as far as mitigation of risk. So that's an important part of this dynamic. And then the other third and final thing I would say to you too is just like whomever can give you proof of execution or certainty of execution, and you'll know that people are responsive, they can explain to you what's going on, how it's going on. Value that too. I see a lot of applicants in the space, again, going back to what we talked about earlier, trading rate and term for speed and efficiency, and they're trading rate over structure. And I think we're so used to rate because a lot of us have bought homes or had credit cards. And so rate is an important part of this conversation. It certainly is, right? Like we want a lower rate, but term is perhaps more important. And then also the ability of the lender that you're working for to explain something to you, and then also their ability to execute on what they're saying to you is even more important because they're going to either get something done for you and explain to you that process, or you're going to get a lot of folks that are going to be in this space that might, dangle a lower rate in front of you, but a poorer structure, or it might be a more drawn out process. So these are kind of some of the things I would think about as you're kind of listening through that dynamic or that conversation with a lender.
Amazing. I love it. Love what I'm hearing. All right, so one last question for you both before we move to questions from the audience. Um, you can be as brief as you like. If you had to give one piece of advice to a business applying for funding tomorrow, what would it be? And we'll start with Connor.
I think I said it. I mean, I approached that conversation with ears open, and then I would approach that conversation with the curiosity, one, to see if you can acquire capital, and then two, what you can learn about your business. And then the third and final thing I would say too is exactly what we've been talking about throughout this presentation. It's like have your financial documents ready because that's really a core part of this application. So the clearer you can be on those, the better quality those are, the more enjoyable and more efficient of a process you're going to have through the lending conversation with the lender.
Yeah,
Stephanie?
I think my answer is not too dissimilar from Connor. Be curious, ask questions, try to become more familiar with the process. Like, be curious and educating yourself. Like, this, as an entrepreneur, you should be striving to constantly learn. You want to constantly learn. And if, to Connor's point, if you did get declined for a loan, it's not the end of the world, right? We can learn from this. We can grow. What are things that I'm not doing internally that I need to reorganize because of this conversation that I had with the lender? You recognize that there are some things on your credit that you need to take care of. Don't take the process of being declined for a loan as I can't do this business. It's just now we have to take a look internally and see what we can change. I think being open-minded and asking questions, exactly what Connor said, is important.
Amazing. Thank you. Thank you both so much for your responses and your insight on these questions and on these topics. So as I mentioned, I'm gonna move us forward to the Q&A portion of this discussion. We already had some questions. Thank you all in the audience for proposing some questions. So we're gonna start pulling from those. And to start, we received several questions around um, regarding pre-startup businesses accessing capital. So can maybe I'll ask this. I'll aim this to you, Stephanie. Can you talk about what opportunities pre-startups have to access capital?
Yeah, so there are lending options for pre-startups, but obviously there's things that you need to have in place to be prepared. So just like when you're buying a house, you have to put money down. The equivalent is true when it comes to getting a business loan for a business that is just starting. So we don't have historical financials to look at. We will look at your projections, but we want to see that you have skin in the game. No one's going to give you all the money that you need, and then you just fly with it. And then if it fails, it fails. You don't pay any back. You don't lose any money of your own. So typically the rule of thumb is 20/80. So you want to have 20% of the total project costs saved or already invested in the business, and the lender can come in with maybe the 80%. It could be less, it could be more. It depends on the lender. So how do we determine the total project cost? You have to do your financial projections. So there are businesses that can just start without a business plan, without doing projections, and they're fine, but that's not everyone, right? That's the exception, not the rule. So make sure to do your homework beforehand. Find out what the total project cost is. Make sure you have that set aside. You may find that I need 100,000 to start this, and I don't have the 20,000 set aside. So maybe we want to start smaller. If you wanted to open a restaurant, maybe now we start with a catering business, and the capital injection for that might be 10,000 or maybe 5,000, something that's more manageable for you. So there are options for financing, but we need to see good credit, a strong business plan, a business plan that makes sense, right? So you have experience in the industry. We're looking for industry experts, especially as a pre-startup, because we don't know if you will be successful. So have some experience, if not yourself, or have a partner who has the experience that can add value to the application. And I'm sure, Connor, you have more points for pre-startups when it comes to getting funding.
There's four key things I think you're going to be looking for. Equity, 20% is fair. Industry expertise in the space in which you're looking to start the business. Collateral actually matters on this one because it is pre-revenue. So collateral will be taken as a consideration. And then outside income. You want to make sure you have some source of outside income to defray personal living expenses, especially if you're kind of starting the business, because obviously you can't take a salary to begin in the initial months or year of that startup business.
Yeah, that's a big one. The last point that Connor made, I find a lot of business owners will quit their job and then want to start the business. If you could keep your job and like slowly let go of it or move to a part-time while the business is getting to a good place, that's really helpful with the financing options.
I will also just want to give a shout out to the New York City Funds Finder platform as well. So if you're a business, a pre-startup business, someone just getting started, or at any stage of business operation, you can go onto that platform. You would create a profile, and based on the profile, you would get matched with lenders that have products and programs that are appropriate for that business stage. So there are some lenders on there specifically that have products for pre-startup businesses as well. Alrighty. The next question, it's multiple questions or multiple parts to a question. I'm gonna aim this to you, Connor. And the question is, if there are multiple partners in the startup business, one, do we need collateral in order to qualify for a loan? Two, will everyone need to show personal tax returns to the lender? And then three, what is the ratio for asking capital versus putting down personal capital injection, essentially?
The first two questions would be yes and yes. And then the last question would be that 20/80 ratio that Stephanie was describing. So generally, we're looking for 20% equity into the project, and then the 80 remaining percentage can be funded from loan funds.
Thank you. And question here, I've heard the term high risk business. What does that actually mean? Connor, do you want to respond to that?
I've not heard that term. So I mean, I think like in general, small business is risky. I think perhaps what you're alluding to is certain industry risks that lenders might be averse to. most lenders are going to be looking for businesses to lend to, especially kind of in the commercial business lending space that are producing a tangible service or product. So they're not going to be, we're not the types of lenders that you would come to if you're doing like a real estate business or if you're going to be another lender itself. There's been some trepidation around some core industries like transportation has been rocked by a lot of the volatility and uncertainty that you see in the economy right now. So some lenders have kind of like specialty industries that they shy away from. But that's kind of the best way I can answer that question for you. But you can ask a lender, hey, what's your industry risk specific to some industries that you're working in or not working in? And certainly, a lender is going to spell out to you too whether they can do real estate or can't do real estate as a primary business, and so on and so forth.
Stephanie, I'm gonna ask this question towards you. Is there any chance to get capital for an absolutely new company that doesn't generate any revenue yet?
Yeah, so we just had this conversation, right? The business plan is helpful, well, is required, and the projections. Your last 3 years of personal tax returns is what we're looking for. It has to make sense, right? Do you have a market that you can tap into? So typically what we see, if you're already working in the industry, you tend to know the players in there, you tend to know how to find the clients that you're looking for. You usually find that there's a problem currently in the industry that you're working in, and from that you can tap into clients. So if there's not a clear vision as to how you're going to generate these clients, aka how are you going to get revenue, how are you going to pay me back, then it's going to be harder for you to get financing for your business. So it has to make sense how you plan to get money in the door so that the lender can get paid back.
Thank you. I'll put this question out for either of you. Essentially, the question is asking if within their previous role for a large organization, they functioned. So a person is trying to start a business that essentially is a role that they played within their previous organization. How do they present that to a lending institution so they have experience in the sector?
I think a lot of like industry stuff specific to industry experience, like you have to remember the lender's not looking for like a perfect match. So like if it's relatable business experience, I've seen a lot of success where people are trying to launch businesses, but maybe have like strong sales experience, strong management experience. That's going to qualify. So it doesn't have to be perfect. I think where you kind of get like into some, I don't understand what you're doing here type of stuff is like maybe you want to start a restaurant and you've worked for the past X years as a nurse or whatever it might have been. It's like that's where we kind of start to say to ourselves, like, I'm struggling to understand what expertise you have in this field in order to start it. And that's not to say you couldn't gain that expertise. It just means you got to go out there and kind of learn a little bit about the industry before you would come back and apply for a loan.
Thank you, Connor. And
Sure.
Stephanie, does it help to get a woman-owned business certification? Let's say MWBE certification. Any benefits for WBEs?
Yeah, I historically I did see more products specific for women-owned businesses. There are fewer, but there still are some lenders that lend specifically to women-owned businesses. I don't know if you necessarily need the certification to access the capital, but the certification has its own benefits when it comes to getting contracts with the city, or even some private businesses may want to work with a business that has that certification. So when it comes to accessing capital specifically, I haven't had a lender say whether or not a woman can get it and require that certification.
Thank you, Stephanie. And Connor, how do bankers or lenders determine a business's ability to succeed?
I think that's going to get back to our ability to look at the financial documents and understand where the business has been, where it's going to go with our funding. So again, we're going to be telling the story based on that balance sheet and that P&L that we see in the tax returns and in the company prepared financials as to where and what happened with that business historically. So that's how we're going to kind of do an analysis of success or not success. And then, of course, we're going to synthesize that all with the conversation we have with you about your character, about where you're going to go with the funds that you're going to be using and how that will lead to further growth. And that's how we're going to assess success.
Thank you. And I'll ask you both those questions. I'd love to hear your perspectives on this. Let's start with Stephanie. Stephanie, could you outline the essential components needed in a business plan?
Yeah. First of all, the business plan does not have to be like a 60-page document. It can, if we would prefer it's not. My lenders don't want to read through the whole thing. If you can put into a deck, even better, but make sure you include these key details. So the business description, what is the business that you're operating? I would also highlight there what makes you different from somebody else who's doing the same work. We want to have the business description, your value add to Connor's point, like maybe you have experience in accounting and it ties into what you're doing with your business. What's the transferable skills that you have to run this business? What's the next thing on the business plan? The market research. So, who's your target market? Obviously, we want everybody to take advantage of your product or service, but there's going to be a specific group that's going to spend more money. We want you to identify who they are, where you're going to find them, how you're going to reach them, what's your marketing plan to get them in the door. Outlining who your competitors are, what's the value add that you have as opposed to them, how can you possibly take clients away from them. I would like you to also include the industry norms for that industry, and give me assumptions as to how you plan to make money. So I expect to have like 5 clients every day. On average, they price for the product that they're going to buy is going to be XYZ. I plan to make XYZ for a month, and so giving me high level understanding of the assumptions for your business would be included in the business plan. I think I have everything that's in the business plan.
Connor, from a lender's perspective, does that differ much from what Stephanie called out?
Yeah, I'm not a big lover of business plans. I think to Stephanie's point, it's like you want to just make sure that it's short and sweet and to the point. What's the opportunity? Where is it going to be? What are the risks? What are the strengths? How are you going to staff and service this business? I think more effective than even just like a executive summary is probably the projections that you're going to put together and something like that. So the numbers behind those projections and the assumptions are really kind of even more critical than the business plan. The business plan, I think, can be a complement to that, but it really can be relatively brief. I like executive summaries and business plans because I think when you write something, you own it. So I think it's more to benefit you even than perhaps the lender.
And a question that ties to what we're talking about now is, are these principles only for loans, or would this also apply for lines of credit? Are there extra steps needed to be taken for lines of credit?
A line of credit is typically easier. With the lines of credit, it's not always, but for the most part, is through a bank, like a brick and mortar location. Not necessarily brick and mortar. Let me take a step back. It's typically through a bank that we would get a line of credit, and they would require that the business be in operation for at least 2 years. So that's kind of the biggest difference with the line of credit. But I have found that the documentation for that one is easier for us than to do a traditional term loan.
I think with lines of credit, just beware. I mean, lines of credit are for temporary uses around ARs and inventory. So a lot of people take lines of credit, they're thrilled they got some access to capital, and then they mismatch use to source. And so they take a line of credit and then fund like a build out, or take a line of credit and fund permanent working capital, which is more of kind of a permanent long-term need. And so especially kind of in the uncertainty and volatility of the economy that we're in right now, you want to be careful with lines of credit because lines can be termed out. They can be arbitrarily termed out at a certain rate and term that the bank determines, not you. So just make sure lines are great, but they should be used for really temporary things, accounts receivable, inventory. They should not be used for build outs, for long-term purchases, et cetera, et cetera. And I think a lot of business owners are so frustrated with the capital dynamic that they get a line and then they mismatch that use with that source.
Yeah.
Thank you. And so next question, if you are a startup company, what does your personal credit and income need to look like? Is credit score the only requirement, or what does a good credit report look like to a lender?
I wouldn't use credit as like the driving force behind startup. I mean, I think for a lot of lenders, 630 and below is going to be hard to support because usually it just means that something still is happening on your personal credit and hasn't been resolved yet. But then the core part of a startup are those 4 things that I was talking about earlier. It's outside income, industry experience, collateral, and then equity in. So it's going to be a synthesis of all those things that will determine whether we're going to proceed forward with a deal or not. So it's not really like any lender I think that you work with that's a good lender shouldn't be just necessarily saying like, this is the metric, this is your personal credit. report number, or this is your personal income number. It should be those four items that I was talking about brought together.
Definitely any thoughts on that?
I did want to add because Connor is in the CDFI space, which is different from like the traditional banks. And so the traditional banks are more strict with their hard numbers. But I think for us, everyone here on the call, we should be playing in the CDFI space when it comes to accessing capital. So we do want to work with lenders like Grow America Fund to get the funding that we need to start and grow our business.
Amazing. Um, here, here's a question. Curious to hear your thoughts on this. So if a business is within a hub zone, would that help them to obtain a loan?
I don't
Connor,
necessarily think it's like a deciding factor. I think when you're located in a hub zone or even like in a low to moderate income census tract, that for some of the lenders, ourselves as CDFIs on this call, that definitely does help us to determine whether we're going to move forward. It's not a deciding factor, though. It's certainly like an indicator. We as a CDFI want to lend in areas in which capital is hard to access, and those are traditionally in hub zones and low to moderate income census tracts. So it helps, but I wouldn't necessarily like lead with that. I think it's a decision that's a synthesis of a lot of factors, and one of those factors can be that as well too.
amazing. I do see a lot of questions on here for specific industries, or specific situations. I will say for some of those questions, the best way to get responses for those, if it's a very particular question, to your case, is to get connected with an advisor, to get connected with someone like Stephanie or myself, or to go through the New York City Funds Finder platform, where you can have a conversation with someone, talk through your unique case, your unique need, and we can help you identify potential lenders or products that would best fit your specific situation. Um, so yeah, so for those of you who are asking questions, I see some questions around real estate or concession stands. Those types of questions, those scenarios, I would think would be best suited in a one-on-one conversation with the lender. I'm sorry, with an advisor. Again, using the New York City Funds Finder platform uh, as a medium to connect. Um, so one last question, and the question is, what is the best way to approach a lender? Do we have to have a prior relationship for better odds of approval? Stephanie, what are your thoughts here? And then Connor, I'd love to hear your thoughts as well.
Um, if we're thinking about a bank, I've had a lot of business owners who like bank with Chase or Bank of America, and they are disappointed that they have all of this money sitting in their bank account and they're not able to access credit with that lender. So in that situation, having that relationship doesn't necessarily mean that you can access the capital. I would say, I think from my experience, you can grow with a CDFI lender. And so maybe right now you wanted the 50, but we can't access that because there's still some things that we need to sort out on your personal credit. Maybe we can start smaller where the lender feels comfortable. And if they see that your repayment is well, you could potentially grow with that lender. That definitely is something that I have seen in the past.
Yeah, I'd agree with that. I think look at capital acquisition as steps on a ladder. There's going to be different lenders that are going to be prepared for different steps of your growth cycle in your business, and you need to build relationships with each one of them. So there's a lot of steps before a bank. CDFIs play a good partner in that space, but there's many steps before you get to the bank, and there's different loan programs and products that will be utilized before you get to the bank. Forming a good relationship to at least get a good explanation coupled with, a lender that understands your business and will go into a room and not only tell the story of your business, but advocate for you and provide solutions to your problems, I think is critical. So start that process sooner rather than later. And, again, work with a lender, like I keep saying, that can explain that to you.
Amazing. Amazing. Thank you. Again, I'm going to wrap it up now. I want to thank you, Connor McCarthy, Stephanie Washington, Thank you both for your time and the amazing insight you provided to us here today. I know I've learned a great deal. Hope others here joining us today also learned a great deal. Again, for those of you in attendance, please, please feel free to connect with us. We will send a follow-up email with information for, those of us present here. You can connect with me, Jose Alaman, Stephanie Washington, or Connor McCarthy. Again, also, or through the New York City Funds Finder platform to get connected to advisors to talk through various programs, lending programs that you may be interested in. Please use those as resources to, get support into accessing the capital that your business is seeking. Again, thank you all for being here. Really appreciate it. Look for that email as a follow-up. And yeah, if you have any further questions, please feel free to send us an email and we'll be happy to connect you. Yeah, that's perfect. All righty.
Thank you.
Thank you all.
Thank you.
Take care.